I made $5,000 in a day trading opening gaps. As you can see, here's some of the proof here. $1,200 on this account and $1,200 on this other funded account. And I have some other accounts outside of these accounts where I made just over $2,400. And in this video, I'm going to show you the only opening gap strategy that I use. I'm going to share my exact strategy and share a key idea that makes it so simple. And the best thing about this opening gap strategy is that it doesn't need a bias. More details as to why that is later on. I'm also going to take it a step further and break down live trade examples that I took using this opening gap strategy so you can see how it's applied in real time in real trade examples. If that sounds good, be sure to stick around and watch this video all the way through to the end. Opening gaps are so powerful because they represent one of the highest probability objectives that price needs to meet. When they are present within the market, they literally act as a magnet for price. Price is literally drawn to them because of this simple fact. The market has only two primary functions, which is to either seek liquidity or inefficiencies. And opening gaps represent one of the highest probability inefficiencies in price. And the reason why they're one of the highest probability inefficiencies in price is simply because an opening gap is a representation of a lack of orders between where the price closed and the opening price, and they're literally a visual representation of the lack of orders. Because you got to think about it, right? Let's say price closed here and it opens here, there was no trading done in between here, and that makes it a high probability inefficiency, because if there was no trading done in between these two price points, that means that there is a literal gap within the market. And if the market has only two functions, which is to either seek liquidity or inefficiencies, this becomes a high probability draw for price, even higher probability than fair value gaps, because I'm sure a lot of you guys know what fair value gaps are. Because if you think about a bullish fair value gap, right, a bullish fair value gap is a buy side imbalance, sell side inefficiency. There is still a measure of selling within a bullish fair value gap, whereas in opening gaps there's literally no buying or selling in between those two price points, therefore making them a high probability draw for price to trade into. And that is exactly why I love opening gaps, because there's no guesswork to be able to spot an opening gap. It's literally there in price and you can see it if it's present. And I know you might be thinking, well, Gerald, you're only talking about new week opening gaps here. No, the same logic can be applied to new day opening gaps and opening range gaps with a little bit of nuance, but we're going to cover that in more detail a bit later on in the video. The key idea behind the opening gap strategy is very simple, and it's so simple that it's like literally almost impossible to mess it up. All we're doing is we're waiting for the opening gap to be present in price, and all we do is we anticipate price to draw into that gap for a gap closure. And by virtue of the opening gap being present in price, this gives us our bias, because you have to remember that one of the two primary functions in price is to seek liquidity and inefficiency. So if the gap is present in price, there's a high likely chance that price is going to draw into that area. And all we're doing is we're going to anticipate price drawing into that area, and we're going to frame trade setups around the gap closure idea using time and price. And when we put it together and we blend time, a high probability time period where we anticipate certain moves to happen within the market, and price by way of using confirmations, we can literally frame high probability setups using these key ideas when they come together and they're confluenced in this way. Because we're going to have an element of time, a time period where we're going to anticipate the gap closure to happen, and then we're going to use price to confirm that the gap closure is actually going to happen. And that's it. So remember, we need time and price confluenced with the gap, right? So what do? The first step is we identify, is there an opening gap within the market? Yes, we identified, okay, that there is an opening gap here in the form of a new week opening gap. The next step is to wait for a key time of day where we anticipate price runs to happen. That could be the London session, the New York session, the AM session, or the PM session. Typically what you are going to find though with new week opening gaps primarily is that the London session is going to provide the move for the gap closure, but that also depends to how relatively close the gap is in relation to where price is currently trading. So if price is trading slightly above it during the London session, there's a high likely chance that price is actually going to draw into the gap. But let's say price gapped up and then continuously traded higher, and then let's say in the New York session we had some sort of reversal, and then going into the AM session now we're starting to see price trade off and price is trading back down, we can anticipate that it's going to be drawing into the gap. So there's a little bit of nuance there in terms of which session is going to provide the gap closure, but more times than not, you're going to see that the London session is going to provide the gap closure. All right, so we've identified the opening gap. We'll wait for the right time of day. In this example, we have the London session as the time of day. And what do we wait for? We wait for confirmation in price. And that confirmation comes by way of a break of structure towards the gap. So once we see that break of structure towards the gap during a key time of day where we anticipate price runs to happen, that is literally a confirmation that there's a high likely chance that price is going to draw into that gap. And once we have that confirmation, all we're waiting for is for a retrade back into the range that price created when it was breaking the market structure. So it would be from the most recent high prior to the low being broken. And we take that range, and all we're doing is we're entering at 50% of the range or above 50%. Ideally, you want to enter at a fair value gap that forms above 50%. And sometimes you might not get a fair value gap. So a rule of mine that I like to use is that just enter at 50% of the range. Your stop loss is going to be at the high that formed before the low being broken. So that's going to be your protective stop loss. And then you're literally just going to be targeting the opening gap. What you're going to do is that if you're bullish, what you're targeting is the upper portion of that range to 50%, because there's a high likely chance that price might react from that upper 25% or 50%. It's not always going to completely fill in the gap. And obviously vice versa. If you're bearish, you want to be targeting the lower 25% towards the 50%, because there's a high likely chance that if price gaps down, it's going to retrade into the lower half of it, and it's not going to give a full gap closure. Sometimes you might get a full gap closure, but you're not going to anticipate that to happen. You're just going to be looking for those low hanging fruit objectives, and that's what you're going to be looking to frame your setups at. And that's literally it, guys. This is literally the framework for this opening gap strategy, and this is literally how I was able to frame a trade that allowed me to make $5,000 in a day. It was built around these ideas. Now let's actually go in and break down those trades so you can actually see how this logic was actually applied to those trades and how I was able to actually make a profit on those trades. For this setup, we actually took a short during the London session, and going into the London session, we saw that price had made a new week opening gap. Once I identified that there was a gap present in price, immediately I'm then now waiting for time of day. So I waited for the London session, and going into the London session, I saw that price was relatively trading near to this opening gap. And by virtue of the opening gap being in close proximity to where price is actually currently trading at, that adds a further increase in probability for price actually drawing into that, because price then doesn't actually even need to do too much to be able to draw into a high probability inefficiency. So going into the London session, what do we see? We saw London open, made a high, broke structure lower towards the opening gap, and the break of structure towards the opening gap during the right time of day confirmed to me that there's a high likely chance that price is going to draw into that opening gap. And on top of that, the fact that price is trading relatively close to the opening gap, that adds further and increases the probabilities. So all I have to now do is to think, okay, is there enough of a range from where price is currently trading at to that opening gap to be able to frame a trade? And as you can see, from when price broke the structure, it's at what, 28,620 to the first target of our opening gaps. Remember, if it's a bullish opening gaps, we're targeting the upper portion, the upper 25% or 50%. The upper 25% of that new opening gap is at 28,500. So from 28,620 to 28,500, that's enough of a range to frame a profitable setup. So I literally waited for price to retrade back into the range that it created when it broke the low, and then I went short literally around here, and then I targeted the upper 25% of the new week opening gap as first target. And that was literally it for that short setup. Beautiful trade. And remember, this is a new week opening gap, but the same logic can be applied to new day opening gaps, which can happen a bit more frequently, and opening range gaps as well. But with opening range gaps, there's a little bit more nuance that comes with it, because with opening range gaps, you're literally using the market's close on a day-to-day basis around, I think, 5 p.m. now, 5 p.m. EST, between 4:30 and 5 p.m. EST, I think. And then in the New York Open at 9:30, if you literally go to the bottom right, if you're using TradingView, you can see the electronic hours and the regular trading hours. If you can toggle to the regular trading hours at the bottom right, if you literally go to the bottom right of your chart, you'll see it says ETH, and then if you click on it, it will say RTH. That will allow you to switch to regular trading hours. Regular trading hours, this is specifically for opening range gaps. Regular trading hours shows you previous day's settling price and the new day's opening price at 9:30, and very frequently there's going to be a gap present there, but you can only observe that gap by switching over to regular trading hours. But the idea around the opening range gap, and you're going to want to note this down, this is specifically for opening range gaps, is that if the gap is larger than 100 points, you're not going to anticipate price to trade back into that opening range gap, because there's a high likely chance that price is just going to continue in the direction of the gap. However, if the opening range gap is less than 100 points, there is a 75% chance that price is actually going to trade back into that opening range gap and provide a gap closure. And if there is enough distance between where price currently is to that opening range gap, you can then frame a setup towards that opening range gap using the same criteria and logic I've shared with you in this video. And the reason why opening range gaps are a bit more nuanced is because you're actually just using the settling price and the opening price at 9:30. In between that, there's gonna be the London session and the New York session, right? The regular trading hours doesn't account for the London session and the New York session. It only accounts for the opening price at 9:30. So it's very important that you guys stick to the rules around the opening range gaps that I've given you. But what you're gonna see is that the opening range gap is actually gonna be the one that's gonna provide the most frequent setups, because they literally form every other day, if not most days of the week. If you're a bit confused and stuck on market structure, I highly recommend you go watch my video that I made on market structure. Go into super detail around market structure. I'm going to leave a link to that video right here. Go check that video out. I hope you guys find a ton of value in this video. If you did, let me know in the comments below what you found valuable. Let me know in the comments below as well if you want a complete separate video on opening range gaps, because I know we did kind of brush over it. But if you want a complete video with trade examples, let me know that in the comments below. And if there are enough comments, I will make a complete separate video on that. Like, comment, subscribe, and I'll see you guys in the next video.